Don't you ever wonder when the right or the wrong time to invest is? Like, you've likely thought about this at some point when you have funds ready to invest, right? Well, the market, especially since April 2020, seems like it's been on fire and can't be stopped, which then leads you to wonder if you're better off waiting it out, right? I mean, I certainly have been there before. I still have to remind myself of this when I go to add funds to my investment account, and I think, what if the market were to drop tomorrow? Should I just wait until next week? I mean, it's human nature to do this, so don't feel guilty for thinking this way. Now, as humans, we are naturally risk averse, so we tend to think about the potential negative outcomes when making decisions. Sometimes, those negative thoughts can far outweigh the positive thoughts, and this is likely some evolutionary concept that helped us survive as humans, right? I mean, I guess if we only thought about the positive outcomes, we'd live in some fantasy world where the market only goes up and up, which kind of feels like the last couple of years, right? Okay, let's not go down that rabbit hole. Let's instead talk about how you can train your thoughts to put yourself in the best potential position so that you have the best investing mindset to build wealth long term. Since March 16th, 2020, when the global stock market reached its bottom point, the market has gone up about 93%. Now, you only actually achieve that return if you actually invested all of your money right on March 16th, 2020, when the market reached that bottom. But how many investors out there actually did that? I mean, the market was in a free fall, and no one even saw any end in sight with the pandemic and how it would impact the economy, right? So it's probably better to look at the total market return since January 2020. And in that case, the market is up about 33% in that time frame. Now, we should probably keep a wider lens on and look at the market with the proper time frames when talking about returns, right? But while the market has gone up, there have certainly been some rough days in getting there. So let's just look at like October 26, 2020, when the market dropped over 5% in one day. I mean, if we hadn't seen such massive single day crashes earlier that year, this would have looked way worse. Or how about February 22nd, 2021, when the market dropped over 3.5%? Or even September 2021, when the market that month was down for about 5%. It wasn't all green every day to get where we are today. Okay, so we can all agree that waiting for a market pullback might feel like the right thing to do. I get it. But studies show that time and time again, this type of waiting game is likely leading to worse outcomes more often than positive outcomes. The best way to actually show this is looking back at the historical data of the stock market and then running tests with that data. And we refer to these as back tests. This is really the best way to show how different scenarios turned out when it comes to investing. And to do this, we'll assume you set aside $100 at the end of each month for investing. In each market day, you check for a market decline and decide whether or not you want to invest. If you don't invest, your money earns daily interest equal to a 1-month treasury bill, which is more than most traditional savings accounts would actually pay you. If you decide to invest, you invest all the money you've set aside since the last time you invested, plus any interest you've earned since then. We'll use 30-year returns of the S&P Total Return Index, beginning October 1, 1991, and then ending on September 30th, 2021. To understand how your investment would have actually performed during these back tests. So over that time period, if you would have waited until the market dropped, let's say 10% each time to invest your money, meaning you held your cash out of the market until you saw that 10% drop, you would have been left with about $175,000. So it's not too bad, right? Now, if you would have not waited at all and simply invested that $100 each month instead of setting aside the cash to wait for downturns, you would have ended up with over $218,000. This means that you would have missed out on over $43,000 in returns by waiting for those big market drops, and in this case, 10%. Now, this table does a great job of showing the final values of your investment in each scenario if you would have waited for a certain market decline to invest. And the results are pretty straightforward.